Hey guys, welcome back to another live stream this week where we're going to go over some open positions that I have here in Tastyworks. We'll take a look at closed trades from the previous week, as well as our typical market analysis and some possible trade ideas for a watch list for next week. So how are you guys doing? Let me know in the chat throughout the live stream if you ever have any questions. Always happy to answer those for you. And be sure and hit the like button and leave me a comment below. I do appreciate it. So I will give it just a minute longer here, see if a couple more people show up before we get started. The futures market just opened, so we'll take a look at that real quick. Yeah, so it looks like we're pretty much opening up right where we closed. So definitely saw breakout higher this past week on the S&P 500. This is the S&P futures right here, and the kind of the only caveat is that tech was weak compared to the rest of the sectors. As usual for our market analysis, we will make a run through all of the sectors and just kind of get a feel of what the market's doing right now. And be sure to let me know in the comments if you guys would. Those of you that are here, just make sure that you can hear me okay. Hate to be sitting here talking to myself. Wouldn't be the first time, though. Yeah, NASDAQ futures pretty much opening up where they were. So interesting. Yeah, I mean, you look at the NASDAQ futures, of course, has that overnight move in there. When we had the big spike up, it was actually in pre-market when the job numbers came out. They were quite a bit lower than expected. And it was one of those situations where you would kind of expect the market to do the inverse of what you would think. Like if the job numbers were really good, I kind of expected the market would actually sell off because there would be fears that the Federal Reserve... Thanks, Ben. How are you, man? But yeah, there would be fears the Federal Reserve would start dialing back on their stimulus and possibly raising interest rates sooner than expected. So obviously the market, would not like that. Right now, it's obviously pricing in low interest rates for quite some time. So obviously we will see if this becomes a trend. If we don't see the job numbers improving, that could indicate that the economy is recovering much slower than expected. So, all right, so let's just go ahead and get started. Not many people show up to the live stream. I'm good. Thanks, Ben. I appreciate it. Are you following me from my YouTube channel, or are you with the Trades with Scott program? Let me just post in the chat room. Okay, already did. Good. Live stream's up. YouTube? Okay, cool. All right, so let's go ahead and jump in. Like I said, first thing I want to do is just run through the positions that I have open here in Tastyworks. We'll take a look at the closed positions from the past week. We were able to lock in a profitable week, but I did make some mistakes, so I definitely want to talk about that. And then we will get into doing the market analysis and the watch list as usual. And of course, looking at that market profile. So first of all, with our open positions here, always starting out here at the top, the S&P futures, we are sitting here with 2 contracts long, and I am cash flowing one of the contracts at the 42.15 call. Obviously, that call is now in the money since the futures have traded higher, currently at 42.29. And I made a couple of mistakes with this past Friday. Actually, what ended up happening is, as we saw that chart just a second ago here, let's go back over to eSignal. So we saw the breakout here above that prior all-time high on Friday of last week. So I made a mistake because I wanted to take advantage of this. So I was scalping this breakout, and I bought a couple of contracts to scalp this breakout up. And when I went to take profit on those it was just a day trade, right? So when I went to take profit on those contracts, I totally forgot that, of course, it's going to do the FIFO first in, first out. And I was, of course, cash flowing the one contract that I was originally holding, which that one contract, let me see, if we go over to my options journal here, let's see. So that one contract I bought on April 26th. So, and I sold it this last Friday on the 7th. So I'd been holding it for 11 days. And when I added into the S&P futures for scalp trade, what ended up happening is it sold that first contract that I'd been holding, and because it was first in, first out. And so obviously that means that now with these new contract, or originally what I just needed one contract because I was cash flowing the one contract. My cost basis is much higher. So now my cost basis on this is actually 42.12. Originally, my cost basis was 41.84. So, obviously much better cost basis there. And that kind of sucks. So I kind of have to remember that if I'm doing this, this buy and hold strategy for cash flowing in the futures, that I really can't be scalping the futures as well because of the fact that it is going to use that first in, first out basis. Let me just check something here. All right. So what I did is I bought another contract, and I was cash flowing originally let's see, which one was I cash flowing? I was cash flowing the 41.85 call. So when the market obviously had that push higher, the 41.85 call went well into the money. And then, so what I had to do is, what I should have done is I should have just let that position get taken away from me. So if you're not familiar, let me just grab drawing tools here. So if you are, say, long one contract of the S&P futures, and then you cash flow that by selling a call, if the futures if the futures trade higher than whatever that strike price is, then you have two choices. You can basically roll this strike price or you can roll this covered call to a higher strike price and a later expiration date hopefully for a credit, so that you can kind of keep that cash flow going without giving up your position in the futures. But the other choice that you have is to just let the position get called away from you. So essentially what's going to happen there is whatever credit you received from that selling that covered call, in my case, I think it was $400. Yeah. So I collected, it's $8, but you essentially you divide by 2. And so you get, it's an actual $400 credit is what I received for selling that 41.85 covered call there. So what ends up happening is what I should have done, I should say, is to just let that position be called away from me. And so if I had done that, if I hadn't have tried to do that scalping day trade, what would happen is that whole one contract that I was long ES would be taken away. And so I would have kept that $400 credit that I sold for that covered call, and I would have also kept the capital appreciation between my cost basis and the strike price. So since I was at the 41.85 strike price, and my original cost basis was 41.84, so that's actually 41.8450, but basically that's a tiny amount of capital appreciation that I would have kept there, and I would have been able to basically keep that small bit of capital appreciation as well as that credit. But what I ended up doing is I rolled to a later strike price, and I rolled it to a strike that is equivalent to my new cost basis. So because I made the mistake of scalping the S&P futures, and because I closed that original position, that first in, first out, and I had to reestablish the position at a higher cost basis, that meant that I really wanted to roll my covered call to that new cost basis. So my new cost basis is 42. I think we just saw it over here. My new cost basis is 42.12 right there. So what I did is I rolled, let's go here. Sorry. So I rolled this 41.85 call from the 5/7 expiration to this coming Friday, 5/14 expiration, and I rolled it up to the 42.15 strike price. So that gets me to that gets this covered call to a strike price that's just above my cost basis. So if the market continues to push higher, I can allow this position to be taken away from me. Essentially, it's just taken away from me, and then I would obviously keep the credit that I received for selling that covered call, as well as whatever capital appreciation there is between my cost basis and the strike price. So there's not really going to be that much capital appreciation, just a couple of points there. But I will get to keep the entire credit that I received. And as you can see, I collected a big credit here because of the fact that I did roll to a later date. And I rolled to basically right at the money at the time that I did that. So that will essentially make up for this small loss here. So when I made that roll, I had to roll it a debit because in order to get it at the strike price for my cost basis, I was not able to get a credit on it. So really the mistake I made is really trying to scalp the futures contracts whenever I'm supposed to be holding them and cash flowing them. So either I need to scalp something else like the NASDAQ futures, or I need to use a different account to do scalping while I'm holding these futures for cash flowing. So when the market obviously exhibited a lot of strength, I decided to come in and add an extra contract. So I'm actually holding 2 contracts long on the S&P futures there. And the reason I had to do that is because I needed to adjust my overall delta on the position. You can see that my delta here for the S&P, you can see my delta for the long S&P futures is 701. And my delta for the short is negative 507. So obviously it's skewed more bullish, as it should be, because we've broken out above all-time high. And right now it looks like the market wants to continue to push higher. The NASDAQ is actually a little bit of a different story. It doesn't seem as strong as the S&P 500, and that's partly because of the fact that a lot of the value type names are the ones that have been really rallying the most, where tech has been weaker. And so the S&P 500 is made up of a lot of those type of value names. So right now we do have a bullish skew, and obviously I have to adjust my underlying positions, be it adding to my long S&P futures contracts or adding to my short MES contracts, that's the micro S&P futures, or adjusting the cash flowing, right? So if you see here again, I'm only cash flowing one of these contracts. So essentially I have an open contract that's just not being cash flowed at all. And that is helping me with my delta for that bullish skew. Now we look at the micro, the S&P future micro. So this is essentially, again, it's not as leveraged. So 10 of the MES is equivalent to 1 of the ES. So you can see here that I'm short 11 of the MES contracts. And obviously that is, that's playing into the bullish skew. So I'm leaning more towards the long side there with the 2 ES contracts. So I'm short 11 of those contracts there. Obviously, I am down on those with the market pushing higher, but the 2 ES contracts here are helping to hedge that position. And you have to also take into consideration the cash flow that I've brought in from those positions. So that is going to adjust your cost basis. And really we're just kind of balancing these two with the appropriate skew depending on what the market is doing. So I'm only cash flowing 4 of these 11 contracts here. So I'm cash flowing 4 of those from a 41.70 strike price because these are short. So of course we're cash flowing puts, so it's covered puts instead of covered calls. And there is, so I brought in $425 in credit from just selling 4 of those contracts there. There's still $184 of extrinsic out there in these contracts. So obviously I'm going to let this ride a bit more. These expire at the end of the week. So we still have 5 days left on those. If I need to, of course, I can come in and cash flow some more of these. Obviously, the more of these MES contracts that I cash flow, the more it's going to adjust the skew to being more bullish. So you always have to keep that in mind. However many contracts you're cash flowing and however many contracts you're long or short, all of that is going to adjust your skew, and you can monitor that by looking at your deltas. So if we go and take a look at for the week overall, let's see, where do we, so from here, is it 5-3, closed on 5-3, that was Monday, yeah. So for the week overall, I brought in $446.30 just from cash flowing the ES and MES positions. And like I said, this $71 loss here really shouldn't have happened. If I had just let that position be taken away from me, this should have been a $400 profit from cash flowing this 41.85 call right here. This should have been $400, and then plus I should have gotten about $50 on top of that from the capital appreciation of the underlying. So instead, because I did sell it, I did bring in $1,169 in capital appreciation from that long ES position. But I do need to realize this entire cash flow right here to make up for the roll from the 41.85 call to the 42.15 call. And then the other one that's open here, of course, is our 4 MES contracts that we're cash flowing right there. So that's it on the cash flowing side of things. Let's hop over to the rest of our positions here. So the corn futures just don't seem to want to stop. Let's look at the risk graph on this. Hold on a second, James. I'll look at your question in just a second. All right, so looking at the risk graph on this, I guess the corn futures aren't quite open, but you can see that it is currently trading right up to the call leg here. So I'm going to have a decision to make. If we look at the chart on this, you can see, and I marked it out, right? Here's my call leg. So it's just starting to breach through that call leg. Anywhere inside of this zone is profitable for us, but it's starting to extend outside of that profitability zone. But it's so extended. Look at this RSI. Look how overbought we are on this RSI. You'd have to think that it would pull back eventually, but commodities are different. They can always do their own thing. They're right now, from what I read, they're being driven from basically inflation and a combination of weather events around 3 different parts of the world, specifically drought conditions that's affecting harvest yields. And there was something else I can't remember. But obviously it's driving up prices in all commodities. But corn is definitely one it's just, lumber is another one that's really seen huge spikes in prices. So, it's hard to say if this thing is going to pull back in time. We have, how long do we have left till expiration on these? We have 2 weeks left, so 12 days. So I'm going to have to make a decision, I think, this week, whether I want to try to make another adjustment to this. Unfortunately, I really don't want to put a whole lot more of risk on the table here. You can see that my max loss on this side is going to be about $4,300. Obviously, I don't want to realize that $4,300 loss. So if we continue to push higher and we don't look like we're going to get any kind of a pullback, then we might have to make some kind of a risk mitigation adjustment to this. Maybe we could come in and do something like this. If we come in and turn this into kind of a butterfly here with the same structure. So we would come in with 5 contracts there, look at the curve, right? So now you can see that we would reduce the risk on the upside here and to the left over here to about $2,000. So we'd be cutting the risk down in half, but we'd pretty much be ensuring a loss, because the only way we'd get a profit is inside of this small little tent right here. And the odds of that happening are slim to none. The corn futures would literally have to close inside of this tent at expiration in 2 weeks. So that is one option. You know, I could come in and put in another call leg up here higher, but I'd have to throw so much capital at it in order to really mitigate this risk here and even get it profitable that it's just not something I probably want to do. It's probably going to be putting on way more risk than I'd like to do. Let me look at that. What your comment up here is. Okay, I can't have a long ES position in one account and a short position in the ES in another account. I try to do this with MES. So I don't understand, why can't you have a long ES and a short and a totally separate account? If they're totally separate accounts, you should be able to do that just fine. For me personally, like what I was saying, is the fact that I'm holding ES long and MES long in the same account specifically for cash flowing purposes. If I'm supposed to be holding these contracts and cash flowing them, and then I come in and try to day trade them on top of that, then it's gonna, whenever I take profits on the day trade, it's gonna sell the original contract that I've been holding for however long. And so my cost basis is going to be worse than it originally was, which is going to impact whatever covered call or covered put positions that I have on it. So that's really what got me in trouble, because my original cost basis, like I said, was my original cost basis was 41.8450, and then I did that day trade and I took profit at 42.08, I believe, and so that it sold this original contract here, not the ones that I literally just bought that morning. So that means that my new cost basis, once I reestablished the position, was much higher than the strike price that I had here. So I had this 41.85 strike price because that was just above my cost basis at the time. But when I did that day trade and reestablished the position with a new cost basis of 42.12, I think it was, that meant that if I let that position get taken away from me at that 41.85 strike price, I would have actually realized a loss on the underlying from selling the futures. So it's kind of a lot to think about with these futures. I'm still kind of figuring it out, but as I understand, that's what it takes. Now, if you're talking about trading these in separate accounts, I just don't see how that would really matter. You should be able to have, I should be able to theoretically hold these here for cash flowing in this account and then day trade those same instruments in a totally separate account. So maybe I'm just mixed up on your question there, but that's, as I see it, that's the way it should work. So anyways, so yeah, the corn futures, right now I'm just going to leave it be. I'm not going to make a rush decision to adjust this just yet, but it is something that I need to make a decision on this week, because if I wait till the last week till expiration, and it keeps pushing higher, I'm probably going to be sitting right at max loss before expiration, especially if it pushes up quite a bit higher. So we'll see, but it's looking more and more like this is going to be a losing trade, and unfortunately a lot bigger of a loss than I would like. I mean, if just real quick, just play around with this for a second, right? If we came in with maybe an overlaid another iron condor on top of this, like we could come in at the 805 strike that's got a 15 delta, and then we'll do the same width spread there, and then you come in, I'd have to, wow, I mean, to get any credit, I'd have to come like the 10 deltas all the way at 660, and I don't know if I'd want to come in that tight, because if we do pull back, let's look at the chart. 660 is here. Here's 660. So this is where the new put leg would be if I overlaid this new iron condor on that. I'm not sure I'd want to do that, but let's just look at this on the risk graph. So overlaying this iron condor, you can see that I would have to throw, just to get this here into profit, I would have to throw a lot of money at this. So right there. So I would have to throw another, well, it's going to take another, am I looking at the right account here? No, I'm not. Let me go to this one. All right. So yeah, I would have to throw like another $19,500, $19,600 at this. And that means that I would have a max loss if it just kept going and got through whatever 805 here. really through this whole strike, this whole spread over here. So 825. So at 825, if it closed there or above, I'd have almost a $30,000 loss. That is just unacceptable. So maybe try one more thing. Let's see, where are we trading at now? Let's see if we came in. If I bought the 730 put and shorted the 735 and 740, and then up that to 2. Let's see what this looks like. And then let's increase it. Yeah, see, even that. That's a little bit better than doing just doing the butterfly. But I mean, I'd have to throw a lot more contracts at that. I just don't like that either. I think that the best solution here, if I'm just going to try to mitigate the risk, is to come in and add to this short strike here, and then come in with a long strike there. And then this is just going to have a butterfly sitting there and increase that to the same amount of contracts. And there you go. So we'll see where it opens. I mean, if it opens with a big gap up, that's going to obviously affect the pricing on that. So we'll keep you guys posted on that one. You asked Tasty Works Marty. He said to me that I could not have a short MES in one account and a long MES in another account in my portfolio. Interesting. Well, I appreciate that, James. I did not know that. I wouldn't have thought it would matter because they're totally separate accounts, but there obviously is something to that. So I appreciate that. I will look into that. All right, so moving through the list here, Amazon. So this one is an interesting, this is another broken wing butterfly trade. The open P&L is not correct here. It's showing $270 open. That's probably just quote issues there. If we look at this on the risk graph, you can see that obviously, max profitability is going to be, of course, over our short strikes, as with any butterfly. But because it is a broken wing butterfly, we broke this wing over here. You can see how much distance there is between, the two wings and the body there. This trade, I actually collected a credit on. I collected $135 credit for this trade. So the beautiful thing about this is that there's zero risk to the upside for Amazon. So if it just keeps going higher, stays where it is, or even comes down lower, I will keep that full credit. You can see, though, that the trade will expand very nicely if we were to see a move lower. So when we saw a little bit of weakness in the market this past week before we rounded back up, let's see, what day was that? That was on the 4th. We saw a lot of weakness in the market. It looked like Amazon might head lower, and it might yet still, but you can see that if Amazon works its way down to around 3,200, which is right here, this broken wing butterfly will really start to expand nicely. I think it's highly unlikely that we're going to end up down here at 3,000 at expiration, but you can see max profit on that would be just over $6,600. So the beautiful thing about these trades is that you have multiple ways to profit. And if you structure it like this to where you collect a credit, it really gives you it just gives you, like I said, multiple ways to profit with the chance to kind of hit a home run if it makes the move down to the area that you're looking for. Excuse me. So the caveat to this trade is that it took $27,000 in buying power. $27,500. Now I put this on in my Roth IRA, so you don't really get margin in a retirement account. If you had put this on in a taxable account, they wouldn't have required that entire $27,000. That would be your max loss. Obviously, that would be like an Armageddon situation if Amazon had some catastrophic news by the end of next week and traded all the way down here to this strike down here, which is 2660. So yeah, absolutely. I will, James. I'm definitely going to look into that. It doesn't make sense to me. I'm curious to understand why that is. I don't know if it's just because it's futures or whatever, but yeah, I appreciate that once again. So on Amazon, like I said, it's looking more likely this is just going to be a keep the credit trade. So if Amazon doesn't really have any significant move lower next week, we'll just leave the trade on and let it expire worthless, and we'll get to keep that full $135 credit. If it does start to move lower, we could see the spread expand nicely, and we might be able to take profit before expiration, depending on what the stock is doing. Okay, so Coin. This one I have 2 positions on. One is the original one, which is just 4 shares that I have in my Roth IRA. I invested about $1,300 there. I also opened up a far out of the money and far to expiration naked call in my taxable account. So I bought the 400 call with 621 days till expiration, and I paid $5,320 for that call. Now, obviously, when you buy a really far out of the money call, it's all extrinsic value. So there's a lot of risk with this, because if Coin doesn't ever bounce back up higher, then you're probably going to lose this entire investment here, versus doing something like a Leaps, where you would buy a deep in the money call with a long date till expiration. So it's got so much intrinsic value in it that it's going to behave more like the stock. So obviously with Coin, when we look at the chart, it's been in free fall. And I bought this, I think, what day did I buy that? I think I bought it here, I think I bought it here when it looked like it might be trying to double bottom, and then it continued to sell off lower. So at this point in time, they report earnings next week. I have no idea what those earnings are going to be. It could completely tank and continue to sell off further, or it might just rip higher. So obviously it's a highly speculative play. It's not often that I will buy a naked call like that, especially with a long expiration date. But I thought, it's $5,320. Even if I have to take it off before that, I can always look at different ways to generate some of that loss. I might even look at cash flowing it by selling some calls against it, kind of like a poor man's covered call, since I do have this long contract here. So this one we will see when their earnings come out, and with 621 days till expiration, we have a lot of time for it to start to work for us, but we don't have that entire 621 days, because our break even on this is going to be so high because it is so far out of the money. But if it does have some big turnaround, if their earnings are really big blowout and has a big move back up to 400, this could really expand nicely. So we'll see what happens there. The copper trade, again, was from the Trade with Scott program. This one is just a poor man's covered call as well. Haven't done anything with that. Long a 22 call that we bought at the money. At the time, copper's trading at $29 now. And then we sold a 26 call there that is actually in the money right now. Overall, the position is net green because of the 22 call that has increased in value. But we do have this 26 covered call here that expires in 12 days. So we'll see what we're going to do with that. Peloton is a trade that I actually got the idea from when I was reading through the news, and it's a different kind of, I don't know if you call it an iron condor. If anyone happens to know what this structure is called, if it even has a name, let me know in the comments. But if you look at this, it's obviously kind of like almost like a long iron condor, where instead of you have your profitability tent in the middle and then you're not profitable on the outside, it's the opposite. So we have like this valley of death right here. So the idea with this is that Peloton has had this big move lower. You can see where I marked off my break evens here. So at expiration, I would need Peloton to be on either side of those two lines. And I'm just kind of playing off the probability that it will be somewhere outside of those lines at expiration. And of course, I don't have to hold it all the way to expiration. Unfortunately, because, and I kind of overlooked this, but you can see the profitability curve here kind of in real time. One of the things that I didn't really pay attention to, or just kind of overlooked, was that when their earnings came out, of course the volatility dropped. So for example, if I increase the volatility, I think, what was it, about 20? Yeah, it was about like that. So I think the volatility for this particular strike was around 80 something % before the earnings came out last week. And when their earnings came out, you can see what happened. Like right here, see, I should be profitable, even though we're in this valley of death. This is at expiration, but this curve right here is showing us our profit and loss as of today. Theoretically, right? So I should theoretically be profitable here, but what happened, of course, their earnings came out and then implied volatility dropped. Obviously, you get the IV crush. And so our theoretical profitability line came down with it. So right now, unfortunately, it did have a move higher after their earnings. I think it traded up around 90 or so. Let's see, their earnings came out. Yeah, it traded up to 91. So it traded up to here, and then it gave it all back. So that was kind of interesting. So right now we're sitting right in the middle of the valley of death. So it's going to have to make a move. It looks like it would be more profitable for us if it actually made a move to the downside. But it's going to have to make a move one way or the other for this trade to turn a profit. So we'll see what comes of that. We still have time on that one. We have 40 days till expiration on that one. The VIX trade, again, was just a hedge on the VIX. Nothing there, just a typical debit spread. And the Yum trade, this is another trade from the Trade with Scott program. This particular one, we did make some adjustments to it. I didn't make all of the adjustments that he did, but you can see that we have this small area of profitability here. Obviously, we need the stock to pull back for this to turn a profit, but we still have 19 days till expiration on that. So that's all of our open positions. Let me just run through what I closed this past week in our options journal. So I actually had a red week in terms of options trading this past week. You can see overall, I made some adjustments here. You can see overall total profit, $524.49, 30 trades, 63% win rate, and average hold time 6 days. So we still have a lot of open trades in here, but just looking at what I closed for this past week, you can see here closing $1,404 net P&L from options, hedges, and my holdings. So not a terrible week, but from the options alone, it is a red week really from this trade right here. So on Netflix, I bought a naked call on Netflix when it was breaking inside of the gap. After their earnings, it had a big gap down and it was breaking up into the gap. It looked like it was going to try to go to fill the gap. So I bought a naked call, and my original plan there was to let it trade higher with the naked call and then sell a call at a higher strike above that to basically give myself protection on that naked call, and I would get a better credit by waiting to sell that call after it made a move higher. Unfortunately, it completely reversed that entire move. Let's just take a look at Netflix chart so you can see what I'm talking about here. So total fake out. Yeah, right here on this day. You see right here where we broke inside the gap right here. So I bought here as we were breaking inside the gap, started to go green, looked good. I wanted to get, a push higher up in here, and then I was going to come in and sell a call somewhere up here in this area, somewhere around all these moving averages. So ideally I have this move higher with the naked call, and then the credit on the strikes up here would be much better. I could sell a call here, and that would kind of protect my profits. If I could sell it for the same price that I bought that naked call for, I'd have a completely risk-free trade. So that would have been a beautiful thing. Unfortunately, Netflix just completely reversed on me. Ended up coming all the way back down. I let it go too far against me than I really should have. So unfortunately, I did realize a $230 loss on that, just on that naked contract. So that's a 46% loss on my capital there. So that was a terrible trade for sure. That one trade right there let me close a red week. So that definitely sucks. The only other notable trade was QQQ. So here on QQQ, I originally opened a put credit spread on the day that the market was really tanking. I opened the 335, 337 put credit spread, but I turned it into an iron condor a little bit later that morning. But I actually got a really bad credit on that because the Qs ended up rallying quite a bit later in the day and opened with a gap higher, I believe, the next day. So I would have been much better served if I had waited till the next day to open the call leg on that. So I ended up being red on that trade the next day. And it wasn't until the day after that that I was finally able to get into the profit zone on it. But one thing that I'll mention about trading the Qs compared to SPY or SPX is that the ability to get fills is a lot harder. There were several times when I was trying to get filled on this, and I was literally dropping my order to the NAT price, and it still wouldn't fill. I'm literally sitting at the NAT price, and it wouldn't fill. So I've never had that problem with SPX or SPY. So I'm kind of hesitant to really do trades on QQQ because of that. I was able to get a profit on it, but really not much to speak of, only a 1.64% return. And really what got me there again was just patience. If I had been more patient and waited till, the next day or even later that afternoon, which unfortunately I had to leave to go to work, to open the call leg, that would have been so much better. So anyways, I guess, profit is profit. So that's good. The Netflix trade here is just a ratio spread that it only cost $7 to put the trade on. It did require $12,000 in capital to hold the position, but it had a lot of profitability potential if Netflix had really sold off. But unfortunately, you can see with the 475 and the 460 strikes, I would have needed Netflix to make quite a move lower. Netflix right now, for reference, is trading around 503, and the low of last week was around 490. So it needed to come quite a bit lower. It only hit around 490. It needed to get down closer to 475 area for this ratio spread to really expand in value. But there was huge profit potential on that for only a $7 risk. So after fees and commissions, I still ended up with a $20 loss on it, but it was worth a shot. It just didn't work out. So that's it. That's all of our positions in Tastyworks. And as of right now, it looks like I said, the futures are pretty much flat. So let's go ahead and hop into our market analysis. We'll look at the market charts, and we'll also look at the market profile. If you guys have any questions, let me know. Let's go ahead and hop into our charts here. So as usual, starting out with our S&P futures, as I was saying, when we were selling off here, we broke below the 20 MA, and you look at it on the SPY as well. You see that we had a break below the 20 MA. It definitely at the time looked bearish. It looked like it was ready to finally have a decent pull. And unfortunately for the bears, we reclaimed the 20 MA and we closed above it. And so, of course, once that happened, we curled right back up and headed up to a new all-time high. Look at your Qs, which, of course, is heavily weighted with technology stocks. Completely different story, right? So we broke below the 20 MA and came down and just about tagged that 50 SMA down here and bounced, but we left behind a doji here on Friday. So a little bit of an indecision candle here for the Qs and really technology to end the week. So we are below the 9 EMA and we are below the 20 SMA. So obviously for the Qs, it's a completely different story. It's going to need to work itself back up here above the 20, back up here into this pocket to have any hope of getting back to the all-time high. So we will see if weakness continues in the NASDAQ index. Eventually, value stocks and energy and financials and all of those sectors that have been really doing well are simply not going to be able to hold up the entire market. If tech remains weak because it's so heavily weighted, a lot of the stocks in there, Apple, Microsoft, Google, etc., they're so heavily weighted in the index that if they remain weak, eventually when value and financials and everything else start to pull back, that will probably be what tech needs to finally sell off. On Friday, it was interesting because it looked like the NASDAQ was just fighting to sell off, but the S&P was so strong, it just wouldn't let it. So very, very interesting. Let's hop into the market profile here and take a look at this. All right, so here is your market profile for the S&P futures. When we look at yesterday's distribution, you can see here is yesterday's distribution here. And you can see that the majority of time we spent trading up here. So here's your value area in the yellow shaded area. This is where we spent the majority of time trading. We opened here. We traded down into about the overnight high and then just rallied all the way up through the prior all-time high, which is here. So we rallied through that prior all-time high, put in a new all-time high, and then traded up here in our value area for the remainder of the day. This looks good. This profile looks healthy. It looks bullish. Everything about this looks fantastic for a continued move higher in the S&P 500. You can see as of right now, we are opening in balance from yesterday. So this here is your developing overnight session that the futures just opened up. It looks like we opened up right here at the Friday settlement, and we are just holding right here in this balance area. So I have not updated this chart since then, so obviously we can get rid of that, and we'll put a new line in here for our new all-time high. And we'll just make that red. Okay, so there's our new all-time high, and when we look below us, there was a virgin point of control here that we did test and repair on Friday, so we can get rid of that. Okay, so on Thursday, we do have some single prints here. Let me mark this off. This is going to be the bottom. All right, so once again, I've talked about this before, but when you see an area of single prints in the middle of the distribution, right? So down here, you have a lot of time, a lot of trading occurred down here, and then it looks like in the end period, which is later in the trading day, we had this explosive move higher, and we just shot higher right up through here, and then into the close, we ended up spending some time right here at the top. So what we left behind is this area of single prints right here in the middle of the structure from Thursday. So this right here is where you expect to be, this is poor market structure, but you would expect that the top of those single prints would provide some kind of support, probably strong support if the buyers were very strong. And so far it seems to be the case, right? But if price falls down below the top of the single prints right here, it's probably going to fall down here pretty quickly. But right now it doesn't seem like that's the case. We've seen this happen time and time again, where we had those single prints in the middle of the distribution, price came down into the top of it, held, and then rallied. So obviously we're nowhere near it right now. But if price does pull back, right? If price does pull back, that 41.9250 level, that's going to be the top of your single prints from the distribution there on Thursday. So that's certainly noteworthy. And then you can see the bottom of the single prints comes in around 41.7975. That also lines up with the high of day here from, I guess that would be Wednesday. So that's noteworthy. We do have that there. All right, so zooming out here, you can see we have this massive balance area right here, and I had marked this balance area low here as being very key, 41.6675. I'm going to leave that on the chart because of the fact that we did have all of these days here supported off of that level. I think that if price were to come back down into that 41.66 level, that will probably be significant given how many days were supported off of that level. So that's good to know that that's there, but obviously it's bullish to see the fact that we did balance. We had a little bit of a look above and fail right here on this day, right? We looked above this balance area, but then we failed it and came back down on this day. And then the prior days after that, or the days after that, I should say, that we came down lower. We finally broke down lower, but then we promptly reclaimed. So we'll keep the balance area low on the chart there. Just looking down here, there was a virgin point of control here that got repaired, so that's good. Did we have one here? All right, so we actually have a virgin point of control right here. Let's mark that. And then continuing to come down. We still have a poor low from April 20th that hasn't been repaired yet. So on the pullback that we got last week right here, this was on the 4th, we didn't get down low enough to repair that poor low, so that's noteworthy. I would definitely see that as bullish. And that's it. So that's the lowest that we pulled back on. Otherwise, we still have remaining below us. We still have a virgin point of control here. We have a virgin point of control here that lines up with 3 days of balance right here. So this would be an area to be aware of at some point in the future whenever the market does finally pull back. Here's another area of single prints right here to keep in mind. Far out of the picture right now. And then we still have this massive gap here below us. So that's about it. Let's take a look one more time here for Friday. We got 2 single prints at the top, so it's not a poor high, so that looks fine. Otherwise, the structure looks good and healthy. And I do like that our virgin point of control here is nice and wide. It's not the widest part of the distribution, but it's nice and wide and kind of right there in the middle of the value area. So like I said, everything there looks healthy. Looking at our NASDAQ market profile, again, a different story. You can see all of the supply overhead here. So the NASDAQ futures has a lot of work to start moving back up here. If it does start to move back up into this area here, I would expect that it would probably find its way back to that all-time high. But you can see here, obviously, it does look considerably weaker than the S&P 500. So we do have, let's see, this virgin point of control is no longer there. And this was a balanced low, extended balanced low, which was also a poor low. This is the low from when the Biden news came out. We can probably get rid of that. 4.9 low, we can get rid of that too. So looking at your, so here's a perfect example of a poor low, right? You see that there's 2 TPO prints right here compared to, look at the high here. You see how there's a lot of single prints here, a lot of single TPOs right here at the high. This is called an excess high. So what you want to see is that you have an excess on the high and an excess on the bottom too. So you look down here, you can see that there's some single prints right here. So you get that excess high and that excess low. So going back to Friday, this past week on the NASDAQ futures, you can see that we don't have that excess low. So that tells you that it's basically an incompleted auction. We basically bounced off of that level so quickly that the sellers didn't really get to complete the auction down there. And so it leaves behind a poor low that typically will want to be repaired. So it's something worth noting, right? So we come in here and just mark that so that we know in the future that that is an area that probably wants to get retested and repaired. So NASDAQ futures are opening within range from Friday. I would expect that if we do pull back, we're definitely going to want to pull back and repair that poor low right there. That'd be the first area that I'd be paying attention to for your NASDAQ futures. And then obviously we need to start moving back up here into all of this overhead supply to make a run towards the all-time high. So let's go back over to our charts. All right. So let's take a look at IWM. We'll make a run through our sectors. So IWM, again, we were talking about the fact that we had this possible head and shoulders here. You could say that it's still trying to play out. It hasn't confirmed one way or the other yet, but here's your left shoulder, here's your head, and here's your right shoulder. Your neckline is this macro trend line right here. So obviously right now there's not much to do with this. It is still just kind of consolidating up here. If you look at your weekly chart, you know, nice healthy consolidation holding above that 20 MA on the weekly chart. So right now, and it also is interesting. You can see that the bottoming tails here, it keeps getting bought up. Every time it comes down into that 20 MA, it keeps getting bought up. So that's definitely noteworthy. If IWM starts to curl back up to that all-time high, this is where we're going to be looking for that trigger point to see if it wants to break out and continue higher. So right now, not much to do with IWM. But it is just kind of a reference point for the broader market as well. Take a look at the Dow. Once again, I rarely look at this because it only has a few stocks in it, but look at the difference, right? Nice, healthy period of consolidation here. Let the 20 MA catch up to the price action, and we see this breakout higher. So Dow looks way, way stronger, way different than when you go and look at the Qs, your NASDAQ index. Very, very different picture here. So I think a lot of indecision here for next week. Unfortunately, for a lot of the stocks that we like to trade, they're in that NASDAQ index, Apple, Facebook, etc. Those are going to be probably a little bit tricky, I think, next week until we get some clarity on what the market wants to do. So let's hop into our sectors. Take a look at our technology sector here. You'll notice it looks very similar to your NASDAQ, of course. One thing that I would kind of point out here is that you have your 20 MA right here on your weekly chart, and you can see that price action came just shy of it and got bought up. Okay, so that is noteworthy, and perhaps we do start to see it push back up to the all-time high. You know, that could certainly play out, but you're going to have to start seeing these stocks like Apple, Facebook, etc. You're going to have to start seeing those really start to rally. When we look at it on our daily chart, obviously we had this pivot high right here. This is where we came in and tried to hold it for a couple of days. Then we got the gap below that. So there's actually not a gap here anymore. Let me get rid of this line. All right, so we had a gap lower where your XLK sector, which are your tech sector rather, caught support on your 50 moving average and bounced up off of that, and right now is still having trouble with this pivot high. So XLK really needs to see a move back up here. You've got your 20 MA just overhead, so that's obviously going to be overhead supply that it's going to have to struggle with. So overall, technology still looks weak compared to everything else as we're fixing to see, but remember, it is your heaviest weighted sector in the index. So if technology remains weak, it's going to be a lot of push-pull in the market next week. Take a look at healthcare, right? So healthcare, new 52-week highs. It did give back, interesting, half of the day here into the close, but it did curl back up in new 52-week highs. So healthcare certainly looks a lot better than technology. Consumer discretionary consolidating, right? It did break below the 20 MA, but it's reclaiming it now. So if we start to push back up here to these highs, it could start to break out higher. Look at your weekly chart again, just getting bought up here with these lower wicks, consolidating, and possibly wants to move higher. So very different picture there as well. Financials, you know, I keep saying that they look overextended. You look at your weekly chart, look how far away we are from the 20 MA, but we've been away from it for so long. There's nothing that says we can't keep going. You look at your daily chart, new 52-week highs, it looks strong. So again, totally different picture there. Communications, a little bit of a doji candle here. And here was that hanging man I talked about last week. You can see that that played out actually beautifully. Price pulled off that hanging man very nicely and then rounded back up. So this one's a little bit more difficult. You're going to have Google, Verizon, AT&T, Disney. I think all of those stocks are in this sector here. A little bit of an indecision candle there for communications. Consumer staples, your typical defensive sector, rounding up new 52-week highs. Industrials, look at that. New 52-week highs. So industrials, again, the reopening trade continues to look good. Basic materials, look at that. Getting extended away from the 9 EMA. So something to keep in mind. You know, it's probably not just going to have, it's probably not going to keep shooting up all this next week. And this is what I'm talking about. You see these sectors here that are really holding the S&P 500 up. They're really providing a lot of strength for the S&P 500, where you have tech that's really lagging. If tech continues to lag, when these sectors here that are getting kind of extended, if they start to pull back and tech continues to be weak, the market's just not going to be able to hold that up. You know, it's going to pull back. So that's something to keep in mind. Even though when we look at the S&P 500, you see that the S&P 500 is breaking out to new all-time highs. It makes sense why when you go through your sectors and you see a lot of those sectors that are breaking out into new all-time highs. But if they start to get extended and tech just remains weak that whole time, when they do finally pull back, that's when I would look out for some kind of a pullback in the S&P 500 and definitely the NASDAQ. So it's something to keep in mind there. So utilities, just a couple more sectors here. Utilities, again, one of your typical defensive sectors, kind of looks like it's just, looks like we're just flagging here, right? So we're trying to hold the moving averages, not very well, but if we start to break above that trend line right there, we could easily see another move higher in utilities. Real estate, I think, did finally hit the all-time high. Yeah, it did. Yeah, I have it marked right there on my daily chart. Pulled back and reclaiming the all-time high. Looks like it might want to round back up and put in a new 52-week high there. And then energy. So this one, actually, I should look and see where that is opening, but there was some news that came out with the pipeline or something being hacked this weekend. So that could have some type of an impact on the energy sector. But as you can see, we talked about, I think in last week's video, if we look at our weekly chart, let's go to the monthly chart. I had this trend line drawn here and said that we might see it work its way back up into the 60s. It's not quite there yet, but it's looking like it wants to work its way up there. Let me just look and see where oil is opening. Is it open yet? I don't think oil's open yet. Does anyone know? Let me look real quick. It is open. Yeah. So, yeah. So it opened with a gap higher. Let's see. Oil closed last week at 64.82, and it's trading right now around 65. So a small gap up. Obviously, some reaction to that news, but that's it. All right, so energy, like I said, it's gapping up higher. We'll see how it reacts to that news. It's very politically driven as well, so it's not something that I really actively trade, and it's such a small weight in the index, but it is one of the sectors that we want to look at. I would just also mention that gold has made a big run higher. I've had this descending channel on the chart here. Oh, that's a little too far out. Here you go. Here's your weekly chart. So I had this descending channel right here. You can see that it's respecting it very nicely, and it's already made a push up towards the upper part of that channel. So that might be something to look at. Again, I don't really trade gold. Indecision candle here, trading higher, I believe, because of the dollar. So all of these things that I don't fully understand because I don't trade correlations between oil and gold and the dollar and all of that. I'm not really a commodities trader, and probably one of the reasons that I'm getting hurt so bad in corn. But anyway, so there is your sectors. Let's make a run through our Fang Man plus T stocks, as Peter would call it there. So taking a look at Apple. Let's zoom out on this, and we'll just move this over so we get a little bit more screen real estate here. So Apple broke below the 132.63 level. Really, you could call... yeah, I'd say about that. Right here overhead, you can see that we have the 9 EMA sitting right here, and you got the 20 SMA right here. So with Apple, unfortunately, I just don't see much to do with this stock until it really gets back up here over the 132 area, because you've got right there at 132, you've got your 20 SMA sitting right there. And then, of course, you have this 132.63 level, which was a prior pivot high. So that's definitely a level to know, to make note of. I think that it needs to reclaim that for the bulls, right? We did come in and bounce off of the 50 SMA there and the 126.76 level. So that is noteworthy. Technically, it is a higher low. It's higher than this low down here. So we'll see if Apple wants to have a run back up to 132.63. And then if it does want to get back inside this pocket here, maybe it finally makes it run to 137.98. So right now, I just don't see anything to do with Apple until it gets up here to 132.63 and confirms that as support for any kind of a long. To the downside, you can see that it's got a lot of demand below us. You've got the 128.72, you've got that 126.76, and you've got that 50 SMA. So really, Apple's going to have to move back down inside of this pocket for any kind of a notable short. So unfortunately, I just don't see anything to do with Apple. Looking at AMD. Was looking at this trend here. We did get that break. Right now it's trading up into all of your moving averages right here. You got your 9, your 50, your 20, all sitting right overhead. So to me, it's looking like obviously that could be some overhead resistance. If it wants to start coming back lower, we still have the top of this gap here that it has not gotten back down to test. Really, you're going to have to see the break below the low of last week, which was on Thursday, for a move back down to, what is that, 74? I just don't like it. I just don't see much to do, unfortunately, with AMD either. Take a look at Amazon. So again, Amazon, I talked about the trade that I have open on that, the broken wing butterfly. So my short strike is at 3,000. So let me just mark this out for you guys. All right, so my short strike is right here, right? So this is where I'm short 2 contracts right there. And then my wings are at 2660 which you can't even see, it's way down here. And the top wing is at 3065, so about right here. Whoops. All right, so I'm +1 here, and then +1 way down here. So here's the structure. Obviously, my area of max profitability at expiration is going to be right here. This is where I would need Amazon to close on Friday this coming week to realize $6,600 in profit. Of course, I would not hold that to expiration because of the huge risk to the downside. If Amazon starts to head lower here, we're looking at a substantial loss. But when you look at this chart, it's got some work to do, right? So even if it makes a run down here to 3,200, it would need to do that within a couple of days. And you can see that right there, you've got a confluence of support. You've got your 100 SMA, you've got your 50 SMA, and you've got your 200 SMA. So the odds that Amazon is just going to fall through all of that is probably slim to none. But if it can work its way down to 3,200 by maybe Tuesday next week, there should be more profit in that spread. But if it's Wednesday or Thursday, it's just gonna be too late in the week for the spread to expand enough. It would have to come all the way down here. So at that point, it would just be keeping that full credit that I received, which again was $135. So it's a good demonstration of what the spread looks like as seen on the technical chart. When we look at Amazon, again, it's another stock that I just don't see a lot to do with. You've got this trend line here that we broke out above. We came up into the all-time high on their earnings and gave all of that back. We fell back below that trend. There is a notable pivot high here. That's not the drawing tool that I wanted. There is a notable pivot high here at 33.44.29, right? So you can clearly see all of this. You can clearly see all of this price action here. I get the right drawing tool, right? So you can see all of this price action here is trading underneath that 33.44. And how many times did we try to break above that? 1, 2, 3, and 4. 4 times. 4 times we've tried to break above 33.44. And every time we fall right back below it. So that doesn't look good at all for Amazon. So when we're talking about for trade ideas for next week, right now, again, I just don't see anything to do with it because you can't really be shorting it right here. There's not much room to work with until you get into these moving averages. And then overhead, it's got to get back over that 33.44, your 9 and your 20. It's got to work its way back up here for it to have any hope of getting back up to the all-time high. So again, another stock where I just don't see anything to do with that. Facebook. Facebook might be okay if it can get back above Friday's high. So you're looking at, Friday's high is right here. And I should remove this because that gap is no longer there. There is still a gap here. So you can see Facebook, this is on their earnings, significant gap higher. It faded pretty much the whole gap, came into your 9 EMA and is trying to hold that 9 EMA. So if Facebook comes back down into this 315.88 level this next week and it keeps holding there, that might be worth a long, right, for a move back up into this pocket. But once again, we're going to have to see tech show some kind of a strength. If tech isn't showing strength, these stocks like Facebook, Apple, they're just not going to catch a bid. But obviously, if that 315.88 holds, that's a possible area where I'd look at buying and hopefully get a move back up to the all-time high. But it's got some work to do. So maybe Facebook looks good. Watch the 315.88. As long as we're holding above that 9 EMA, there is potential there. So that one probably looks the best out of everything we've looked at so far. Google, I don't really day trade this one much. Microsoft looks exactly like the Qs. It is above the 9 EMA, but you can see overhead you've got 20 SMA. So you've got supply overhead. There is an unfilled gap right here. You can see I have an alert set. So this is what I'd be looking for the gap play. If Microsoft gets inside of this gap, maybe there's something there. To the downside, don't really like much of it there. You've got this prior pivot high here that it's holding in that 50 SMA. So I just, I just don't see anything to do with Microsoft, at least right now. Take a look at Netflix. Netflix still stuck inside of this range here. I'm not going to be touching this thing. It already faked me out, as we said right here on this, tried to go for this gap fill, and I'm probably not going to trust it if it does it again. So not going to be touching that next week until we get some clear direction there. Right now it's just going sideways. NVIDIA, possible trend here where we could see a flag break. So that would be worth watching. You see I have my alert sitting right there. You do have the 20 SMA right overhead, and then you've got this prior pivot high here at 614.90. Nice size pocket here, though, to work with. NVIDIA hasn't reported their earnings. They're one of the few tech companies that hasn't reported yet. Maybe someone can tell me in chat. But I don't know exactly when they report. I think I can look here. Hold on a second. Okay, so they report on May 26th, so still a couple weeks away. So yeah, like I said, NVIDIA looks very similar to the Qs. Need to see it break the flag, and nice size pocket here to work with. To the downside, don't really like it. You've got your 50 MA. It's already had the move down and bounced. So unless there's considerable weakness that shows up in the market, not really going to be looking for a lot of shorts until we see that. So let's see if NVIDIA can move above the flag. Maybe there's something there. And lastly, Tesla. Okay, so this one's definitely worth a watch. So you've got this trend line here that we've talked about several times, right? So you have this trend line. You can't. It starts way back there, but you can see we've got it anchored here. We caught support here. We caught support here, and we're sitting on it again, right? So tighten this up. Here's what I'd be looking for on Tesla. If we start confirming below this trend line here, there's a big ass pocket here to work with Tesla. You've got your 200 MA right here. So that would definitely be noteworthy if it were to come down into that 200 MA. It hasn't tested the 200 MA since I don't even know when. Wow. Tesla hasn't tested the 200 MA since back here when the coronavirus happened in March of 2020. The closest we came was on this drop right here, and we still didn't get there. So obviously when we zoom out on this, you can see that if Tesla breaks that trend, right? If Tesla falls into this pocket, there is a lot of room to work with here. You're probably going to have some, let me see if I can mark this off. You'll have some type of support that comes in here, right there, from that swing low right there. And that's right near the 200 MA. So if we fall inside this pocket here, there could be a short here for Tesla. I do like that. 591 is the realistic target I'd go for, with the awareness that the 200 MA is just below. And there's also a longer term trend line here that goes to that low from the coronavirus sell-off and is anchored here. That trend line remains untested, and as of right now, it's falling underneath the 200 MA. And then below that, you have a swing high right here at 502 or so. Yeah, 502.49. So Tesla worth a watch for a short inside of this pocket. To the upside, I don't like it right now because of the fact that it's got so much overhead supply. This 695 level remains very key. You can see that we've come up, rejected it. We've come up, rejected, tried to break above, tried to hold, and then now we're back below. So 695 right there definitely remains key. But you can see you have your 20 MA, your 100 MA sitting right inside of this pocket up to 744. So I think that, this pocket here is not really worth messing with. It's going to have to get above 744 for any kind of a long, or a break below this trend line for any kind of a short. So I believe that covers everything I wanted to go over with you guys. If you have any questions, let me know in the comments there. And if you're watching after the fact, leave me a comment and I'll be sure to answer your questions there. And also, for these videos, if you guys have any stocks that you want me to look at that we don't go over here, just let me know. I'll be happy to do some technical analysis on whatever stocks that you might be looking at. As you guys know, I typically trade the same small basket of stocks, so those are pretty much the ones that I'm always looking at. But, all right. Well, I don't see any questions, guys. I appreciate you tuning in. Thanks for those comments, James. I'll look into what you were saying about the Tasty Works and holding the futures on through different accounts. Ariana, hey, sorry I didn't see your comment there. What's up? Thanks for joining. So I'll wrap it up there, guys. Like I said, thanks for tuning in, and we'll look forward to seeing you guys next week. Let's see what the market brings us. Have a great and green week of trading. See you later.